I'm Diane Brady. I'm here with Dave Liniger, who is the co-founder and chairman of RE/MAX Holdings. Mr. Liniger, great to see you. I believe you're now in your 50th year with RE/MAX. Is that correct?
Yes, we just had our 50th anniversary, big convention, 10,000 people here in Las Vegas, and it was very exciting.
Well, one of the things I want to start with is this concern about the housing market. You've got a perspective that few have in terms of just where this fits. You've seen over the last 50 years plus. Where are we right now? What do you think of the state of the housing market? Are we too concerned about some things, not concerned enough about others? Let's just start there.
We're kind of getting close to the end of the problem. Obviously, the biggest aspect we have to deal with is the interest rate. Traditionally, since RE/MAX was founded 50 years ago, the interest rate has had an average housing market for mortgages of 7.76%. If you go back over a period of 7 or 8 different recessions, that interest rate changed off and on. 1980, 81 era, when they were trying to stop inflation, they moved the interest rate up from 7% to 16.5% on FHA and VA mortgages. It took a couple of years for that to taper back down to a more reasonable 7%. A lot of people did buy at the high interest rate. They refinanced, so they weren't stuck for 30 years, so to speak. And then we've had about 12 or 13 years of the lowest interest rates in housing that we've seen in history.
And probably we'll never see again, do you think? That's what a lot of people are telling us, that it's an anomaly.
I don't believe that we'll ever see 3 or 4% interest rates again. The world was just so cash rich, with so much money chasing so few deals, that people were quite happy to get a return on the investment of 3 or 4% long term. Unfortunately, that is gone. The world has gone into several black swans that are affecting our economy and the rest of the world. And so for the foreseeable future, it's hard to forecast. I do believe that the interest rate's going to stay in the 6.5%, 7.5% through the fourth quarter, maybe even to the first quarter. Mm-hmm. But then at that point, the Fed will loosen up and it'll start going back down. So I just don't think we're going to see 5% for quite some time.
Now, I'm here in New York City, and I know in a lot of cities across the U.S., the concept of the starter home, something that my parents had, it feels out of reach for a lot of, especially young people coming up, just given the housing prices. What are you seeing? And I don't know if there's any particular fix for this other than increasing the housing stock.
Yeah, it's a very difficult process to deal with. In reality, the excessively expensive homes have the last 15, 20 years been on the two coasts. The West Coast with California prices, then East Coast, especially you get up in the New England area and so on. Those have kind of led the higher priced properties. The Midwest has been more reasonable. I think Texas, Florida, maybe even Georgia, and they've been fairly decent, not subject to the swings. And so it's very difficult to get a starter home. The worst thing that a realtor can have is a good memory. And you can remember 50 years ago, I was selling houses at $10,000 and $15,000 that are now selling for $400,000 or $500,000. It affects your thinking, but everybody's income has gone up dramatically. You have basically 2 income families, and so people adapt.
Is there? Let's step back from the cities a second and talk about what's changed during the pandemic. We've seen this migration out to the suburbs to some extent. Are you seeing any trends in terms of it moving back into the cities, or are is this something that's going to continue in a way, this move toward away from the coasts as well into some of these second tier markets?
Well, I believe that I was widely quoted, I don't remember, 15 years, 17 years ago, when everybody was talking about the millennials and the younger people all wanted to move into the downtown core areas. They wanted the museums, sports, bars, entertainment. As a matter of fact, there were a lot of baby boomers that were retiring, and they were kind of moving into the area downtown. Unfortunately, I had predicted that several things would happen. One, when you're single or newly married, no children, you really don't care about parks or schools or churches. And all of a sudden, you get a couple of children and a couple of dogs, and rentals and apartments aren't looking like that good of a deal. And so with the extraordinarily high prices in the downtown areas, we started seeing about 6 or 7 years ago, people being forced to move into the suburbs and start commuting. And then, of course, that was accelerated dramatically during the pandemic, when all of a sudden we realized how big a percentage of the workforce could actually work off location. So some people can't. I mean, if you're working in a fast food restaurant or you're in a department store, that's a little different problem for you. I think that the trend of continuing to move to less and less expensive properties, which is the suburbs, and putting up with a commute 2 or 3 days a week, is probably going to continue.
Is there, as a young broker coming into the market, there's so much talk of technology and the impact that technology has had on the real estate market itself. What are you seeing at this point in terms of the degree to which technology is disrupting or helping your industry?
Technology is a tool. 20 years ago, I was quoted widely as stating that real estate agents didn't need technology. The vast majority of the real estate agents needed leads. That technology did morph into a lead generating system, but now you're looking at all the various leads being generated in the United States is in the billions, that's with a B, a year. And so it doesn't necessarily mean that it's a high quality lead. And there's only 5 million residential listings selling a year. And so the leads are not of that much value. This business still comes down to personal referrals, reputation, and repeat customers to a great degree.
Now, you are a global company at this point. I don't know if there's any particular global trends that you're seeing that are of interest. We tend to focus a lot on the U.S. We're seeing a lot of foreign money coming into the U.S., obviously buying real estate here. But are there trends you're seeing in other parts of the world that you'd put on our radar?
Well, the thing that's interesting is the foreign money coming into the United States and Canada was pretty amazing. Even 5-6 years ago, it probably accounted for 10% of the residential sales. That started to dry up dramatically during the pandemic. And now that COVID is kind of under control, you're starting to see the return of foreign nationals wanting to invest here. There's a couple interesting aspects of that. Many people are concerned about their own economy, and if they achieve some wealth, they try to get their wealth out of their country into a more stable environment like the United States or Canada. And you see an awful lot of that in South America, especially Brazil, Venezuela, Colombia, Argentina. And so people are looking for getting money out and safe and secure to where it can't be taxed to pieces by some foreign governments. You're actually seeing the same thing to a great deal with Europe. And of course, the Asian money was very, very strong. And so it was kind of like bargain hunting in the United States or Canada. And that really dropped off with the pandemic. I believe that will start again.
Yeah, and some governments I know have pushed back on that because they also want it affects neighborhoods if it's too much investment properties. Is there anything else that's on your radar, Mr. Liniger, in terms of where you think some of the good investment opportunities are? Because in addition to looking at housing as a place to live, Americans do look at it as a place to invest. Where are you seeing some of the hot areas, or areas maybe formerly hot, that are not going to be the future?
It's interesting of the net migration of people leaving the state of California. They're fed up with crime, fed up with policies of high taxation. They have increased the population of surrounding states: Oregon, Washington, Idaho, Montana, Colorado, New Mexico, Nevada. There's still a great deal of people moving to California, but in reality, people are migrating to better climates and away from crime. And so if you're in the northeast part of the country or the northern part of the country, people do realize, boy, I could live in Florida or Texas or South Carolina. And so those places are seeing a net influx of population, and the old dying industries in areas with poor weather and so on are seeing a migration out.
How much do you think climate change is impacting either real estate prices or how people are moving around the country?
I don't think there's any impact at all. There's two sides to every equation, and the green people are talking about how devastating we're creating our planet, and that we've got to control everything. There's another side that says the cost and the damage we're doing with lithium batteries, windmills, and so on is probably overrated. And so I think the typical home buyer does not worry about climate change. However, there has been a trend in the last 20 years for people to look at homes that are eco-friendly, that have state-of-the-art heating and air conditioning, good insulation, because that keeps the energy costs down. And so that's a selling point for people just as much as having a nice kitchen.
Yeah. Well, and I'm sure insurance rates obviously are changing too in places like Florida as we see more going on there. It's great to see you, Mr. Liniger. Again, let me just end with, over the past 50 years, you've seen many times of opportunity, times of crisis. How would you rank the time we're in right now? Are you optimistic?
This is a mild period of time. It does not compare at all with the recessions back in 73 and 79 with the two oil embargoes, the savings and loan crisis in 1980 and the high interest rates of 82, the tremendous number of foreclosures when 60% of the S&Ls went out of business. And then, of course, the true financial disaster of 2008 because of the subprime mess and all the mortgages that had been given to unqualified people that just walked away from them because they had no equity or no down payment. So this one is fairly mild. In my history with the real estate business, I was first licensed in 1966. I've lived through 9 presidencies and their administrations, and we've managed to make a good living in almost all those years. We've now probably going into our 8th recession in that time period, but this will be a mild recession.
Great. Well, that's great insights, and thanks for joining us, Mr. Liniger.
My pleasure.